Hello and welcome to Season 2, Episode 10 of the Talking Central Banks podcast with me, Carsten Brzeski. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about ECB's monetary policy trajectory, given the geopolitical risk and the economic uncertainties facing the euro area economy. This is in context of ECB's Governing Council's next monetary policy meeting that is scheduled next week between 27th and 28th April. Our guest tonight is Carsten Brzeski, who is the Chief Macro Strategist and Chief Eurozone Economist with ING. Previously, he was the Chief Economist for Germany at the Investment Bank. Before his positions with ING, Carsten was an economist with the Office of Director General for Economics and Financial Affairs at the European Commission. Carsten was a JFK Memorial Policy Fellow at the Center for European Studies at Harvard University and is a graduate of the Free University Berlin. Welcome to the show, Carsten.
Hi, Karen. Thanks for inviting me.
You're very welcome. Pleasure to have you on the show. So, starting with your recent ING commentaries, Carsten, as a run-up to the ECB Governing Council meeting next week. In your most recent commentary, you mentioned that optionality is back on the table, ranging from a cut could be needed if the economy moves towards recession to market bets on two rate hikes, not unreasonable. Please elaborate this line of thinking, Carsten, given the newfound resilience experienced by the euro economy amidst geopolitical risk, including Ukraine and now the Iran crisis.
Yeah. Now, listen, I think let me give me some time or to put this into context. I think
Right.
at the start of the year, ECB monetary policy had almost become boring. So that was the good place that ECB President Lagarde always talked about. Everything was fine. If anything, there might have been a rate cut in the making in case of inflation undershooting. I think it was so boring that ECB watchers started to speculate about the succession for Christine Lagarde and other prominent figures at the ECB. But ECB watchers were no longer really talking about monetary policy. Well, now with the war in the Middle East, this has completely changed. And monetary policy has become extremely exciting again, but also extremely challenging. And for the ECB, they are clearly seeing this stagflationary impact from higher energy prices, from the war in the Middle East for the eurozone economy, and that's why apparently right now there is really full optionality back on the table. What do I mean with that? Well, we had the IMF spring meetings a week ago, and that is normally an occasion when many European central bankers are around and also love to talk to media. And what we heard there in Washington, or at least on the wires, was really everything. There were some ECB officials saying that, like you just mentioned, well, a cut might even be needed if the economy would move towards recession as a result of the war in the Middle East. But others were more saying, well, what current financial market expectations, pricing in two rate hikes are not really unreasonable, hinting that also at least some members at the ECB think, well, there could clearly be room for rate hikes. So we're clearly there again with full optionality. Well, we're going to speak a little bit longer, but what this means is, and that's so often, the ECB is a big institution. The Governing Council is a big governing body, and clearly right now with well, I would say different views. I wouldn't say opposing views, but with different views. And this brings us back more or less really to the question: how should a central bank react to a stagflationary shock? And that is what the energy price shock currently is. Higher energy prices, we see it already at the pump in Europe, higher energy prices kind of denting private consumption. And we just had also today, we had the PMIs coming out again. I must say a big worsening, a big worrying signal coming from leading indicators. So everything that we see right now points to a stagflationary effect. And then the central bank is clearly wondering, okay, should we now react with rate hikes in order to tackle a possible inflationary impact, or should the ECB rather react with rate cuts in order to cushion the adverse effect from higher energy prices on the economy? Well, what do we know in Europe? Final word. What do we know in Europe? If there are so many opposing or different views, normally a good European compromise is to do nothing. And that's why I think, yes, optionality is back on the table. But looking at next week's meeting, I think the outcome will be no rate change at all. And we will rather hear Mrs. Lagarde again talking about that they stand ready to act, they need more information, but that the time is not there yet to really react with monetary policy to the inflationary or stagflationary impact from the war in the Middle East.
Right. You also talk about the ECB not wanting to be called out as being behind the curve, a policy mistake that haunts it from 2022. In this context, Carsten, you argue that this time things are different not only because the ECB's monetary stance being neutral and not accommodative, but also because excess liquidity does not exist in the system. Consumer sentiment remains subdued, unlike the post-COVID pent-up demand surge that we witnessed, and higher bond yields putting downward pressure on credit growth. Does this mean that inflation is transitory, in your opinion, and the ECB may not want to raise rates at this time, even as a signal?
Yeah, and that brings us back up to more of my answer to the first question already. The 2022 experience is really kind of a collective institutional memory at the ECB. And if we do just go back to 2022, what happened then? We saw inflation starting to accelerate in 2021. Back then there was a kind of pandemic lockdown-driven an inflationary shock. Then we had the war in Ukraine that started, the Russian invasion of Ukraine, and that led then to an energy price shock, which accelerated the soaring inflation in Europe. And remember that back then in Europe we had inflation rates going up to 10-12%. The ECB in 2022 was for a long while talking about that this inflationary shock would be transitory, that it's a supply shock that would not require monetary policy to react. And this is why I think the ECB took slightly too long to forcefully intervene and react with rate hikes in order to bring inflation down, or to stop, in the first place, to stop inflation from going up. So that's the institutional memory. And with this memory, and that's of course also the financial markets memories, with this memory, markets had started to price in when the war in the Middle East started, actually quite aggressive rate hikes by the ECB. I think at some point in time, we had markets pricing in 4 rate hikes by the ECB this year. And that was all depending on the ECB will do everything to to prevent another 2022 from happening. But if you then dive more into the details, 2026 is not, in brackets, yet 2022. How come? What is the biggest difference? Well, first of all, in 2022, when the energy price shock hit the European economy, headline inflation was already much higher than it's currently. I think it was already at 3-4% before then the further acceleration materialized. Also, monetary policy was still pretty much accommodative when the energy price shock hit. So the ECB was just coming out of negative interest rates. of quantitative easing. So they still had to do some kind of catching up in order to just get monetary policy to neutral again. So this is where the ECB was behind. And the third point, which I think is very different right now from 2026, is that in 2022, we were just in this post-lockdown era. And the post-lockdown era meant that people, households, were simply willing to pay almost any price they were charged to go outside to buy, to spend on services. So the willingness to spend was pretty high, which also meant that the ability of companies to pass through higher production costs was also extremely high. And that then led to the second and third round effects in inflation, and therefore then was kind of self-enhancing the inflation rates. Well, this time is different. This time, when you look at the willingness to spend, European consumers is pretty low. The labor market is weaker than it was in 2022, and also governments, I think, are looking into much weaker government finances, public finances, and will not be able to provide as much fiscal stimulus to the economy as they did in 2022. So this is why this time is different. Plus, like you mentioned, when you look at the current monetary policy stance, so the interest rate at 2% is a neutral level. On top of that, bond yields at around 3%, 10-year German bond yields are also have gone up quite significantly. And finally, we also see that excess liquidity has also come down. So the overall stance of monetary policy is between neutral and restrictive, which also means that the ECB should be in no hurry, in no rush to now really go into aggressive rate hikes.
Right. Very interesting, Carsten. You also think that next week the ECB will hold rates primarily because not much data is available to have a full-fledged head up on a rate decision. I know you did talk about this, Carsten, in your previous response, but does that actually mean that June insurance hike, as you put it in your commentaries, are on the table?
Yeah, I think both. So more or less to briefly dive into the world of an ECB watcher. So what do we do? What do I have to do? I have to put myself in the shoes of ECB policymakers, and I'm just looking then at what kind of data will there be available at next week's meeting with an ECB, as any central bank or every central bank, always emphasizing that they are highly data dependent. Well, every central bank is.
Right.
But the point is, and that's important. The ECB delivers big rounds of macro forecasts only every 3 months. The last one was in March. The next one will be in June. There won't be a new fully fledged round of macro projections. But which normally is an important piece of data and information for the ECB. Then it's still too early to really gauge the inflationary impact. So what we will be having by next week is a couple of countries will have released their April inflation data, not the Eurozone as a whole yet. Plus, then on the day itself of the ECB meeting, we will have a first estimate for first quarter GDP growth. So and that's my point, too little information to really shift the needle for the ECB. And as there is not this huge urgency to react imminently, this is why the ECB, and also given the different views that we discussed within the Governing Council, I think that is the strongest argument to just wait until the June meeting. If by the June meeting we're still talking about the war in the Middle East, we're still talking about a blockade of the Strait of Hormuz, or just a very gradual reopening by then, then the ECB, I think, will deliver an insurance hike. What do I mean with an insurance hike? So this will not be the start of a series of rate hikes. This is more to maybe fight the ghosts of the 2022 experiences, to demonstrate to financial markets that the ECB stands ready to fight any inflationary pressure. It might not be a conviction call, not even by the ECB itself, because I think also by June there will be some ECB members still saying, well, you could look through any inflationary shock, that they might want to use the word transitory, even though it has become a no-go word in Frankfurt these
Right.
days. But they might use it again.
Yeah.
But more or less, and I think that is, I remember, I think it was Alan Blinder. And I remember it was the former vice chairman of the Fed, who I think in the late 90s wrote a paper saying that monetary policy is, I think, more an art than science. And I think that
Yeah.
explains a lot of these discussions. Yeah. So yes, it's
Yeah.
science. It's science-based art, and this is why an insurance hike will clearly be on the table in June. Will it be a series of insurance hikes in the rest of this year? I'm a bit more doubtful, but one rate hike is clearly something that I can see. And even if it is to demonstrate that the ECB is not only willing but also able to act, and if it maybe also then fulfills the purpose of demonstrating that the governing council is, I think, well, at least with the majority or maybe even unanimously in favor of some rate hikes.
So this will be more of setting inflation expectations, Carsten. These insurance rate hikes that you mentioned.
It is indeed, and that's, I think, where the art part comes in, and I think we could have probably a full episode of your podcast on what is really driving inflation expectations.
Right.
My personal view is that it's actually mainly actual headline inflation. I know I
Mm.
really haven't
Mm.
seen counter evidence yet, but
Right.
clearly for an ECB, for a central bank in general, it is kind of this what the ECB calls anchoring of inflation expectations. That is so important for the ECB, and they only have the tool of interest rates as a main tool. So this is why indeed the rate hike, if it comes in June, will be justified by, we do this in order to fully anchor inflation expectations.
Right. In any case, Carsten, do you think ECB's reaction to the risk is too late as the geopolitical pressure intensifies, or it may risk acting too early, which may in turn weaken growth?
Yeah, I think that's a funny thing. Huh? So I think where in 2022 they were indeed slightly too late, or maybe too hesitant. Right now, if anything, I would argue that they might be too early, if they go, because the starting position is much more comfortable than it was in 2022. And I think there are good arguments, also given that the European economy is not that strong. Also given that we simply need lots of longer term investments. So these are all strong arguments actually against aggressive rate hikes. So yes, I think if I had to choose, I would say that this time around, if they were to hike, that this would come actually too early rather than the too late in 2022.
In the euro money markets, Carsten, there seem to be adequate liquidity given that 1 week and 1 month Euribor rates are falling below euro short-term rates overnight index swaps, or ESTR, OIS as we call them, despite the ECB showing signs of a normalizing balance sheet. Along with the normal demand for ECB liquidity currently penned at around 10 billion euro, Other money market rates, including GC pooling rates, are also abating to normalcy. What is your take on this situation, Carsten? Is the euro market pricing in a short-term liquidity infusion in the system in the coming weeks, in your opinion?
I wouldn't go that far, Karen, yet. I think the first, if you look at the snapshot view, is rather one in which the ECB has so far really nicely managed to get some excess liquidity out of the system, yeah, without disturbing or distorting the system. I think, but there will be more of what the ECB did a couple of years ago with a couple of liquidity injections. So they will fade out over the coming month. So I think right now it is not so much that markets are already kind of pricing in more short-term liquidity in injections. It is rather a success of the ECB's money market management. The challenge will be, I think, in the second half of this year, if when the excess liquidity will drop further, and then the question is whether the ECB can get away without extending the previous liquidity injections.
Right. But by the way, Carsten, non-collateralized lending among commercial banks, as represented by the Euribor, is well below the implied MRO, as suggested by ING's own research, until even the 3-month duration. This leads to the system liquidity being cheaper to central bank liquidity itself, as we discussed previously. So the question, Carsten, that comes to my mind is that is there a structural basis of Euro commercial banks being flush with liquidity at this time? Is there a historical precedent post-COVID that we are witnessing right now?
Yeah, I think well, in the end, the fact that now, well, that the liquidity is again cheaper, simply means that the money market is functioning. Yeah, so I think that is, and that is, well, you have to look back already quite a while, but this is how the money market functioned prior to the financial crisis. So it's only that since the financial crisis, with all the other crises coming in, whether it was in Europe, the sovereign debt crisis, and then again with the pandemic and the war in Ukraine, that the central bank, the ECB, always had to step in as the full lender of last resort. Also, when it comes to liquidity, sometimes also when it came to providing liquidity to banks. I think that, and this would be a success if the ECB now really would manage to get interbank liquidity, interbank operations again running at full speed, more or less in a way as we were used to prior to the financial crisis.
Right. What do you think about the renewed activity in Euro sovereign and private sector primary markets, Carsten? What is causing the chutzpah, in your opinion, at this time?
Well, there's a lot going on currently, especially when you look at sovereign markets. And you know this, and it all now started with the war in the Middle East. Well, initially, what we saw was that sovereign markets reacted with a traditional flight to quality reaction. I think only in the first one or 2 days, there was the moment when then also bond yields actually came down. But then it only took, like I said, I think only 1 or 2 days for markets to realize that this war in the Middle East was clearly inflationary or even stagflationary, and that was what pushed up bond yields of European sovereigns. So, but it is this inflation expectation. On top of that, but I think that is not really fully captured by market pricing yet. It is more a undercurrent that, of course, in the industrialized world, we are seeing that there are more and more demands for governments to increase spending, so to pile up government debt. That I think we are, in my view, we are in the midst of an era of a longer period in which government debt of industrialized countries will continue to increase, simply because of all the investment needs, maybe also the social needs, the redistribution needs. So all of this, and now on top of that, the defense needs. So all of this means that we are clearly looking into a couple of years with probably new record supply of sovereigns, and not only Euro sovereigns, clearly also US sovereigns.
Nevertheless, Carsten, it seems ECB's medium-term emphasis is shifting from fighting the last year's inflation shadows to managing uncertainty around future shocks, including geopolitics and energy. Keen to know your thoughts on this.
Yeah, that is the tricky thing for the ECB, but for central banks in general. So how can central banks now really react to geopolitics? They hardly can. I think, and that could be that's true, but it could be that central banks were so used to this fact that they were the lender of last resort, and the lender of last resort not only in terms of liquidity, also in terms of who is here to help the economies. It was also central banks, and that again applies to, I think, all industrialized nations. And what the ECB is now currently also seeing is that how do geopolitical shocks actually impact the economy? We were all trying to get a feeling for that. Well, the strongest and most evident channel is oil prices, commodity prices, and that's what we're currently witnessing in the Middle East. And if the most important transmission channel via which geopolitics affect the economy and hence also monetary policy, this means that the central bank has to really think twice how it wants to react to new energy price shocks. So the entire discussion, I think, that we just had, but that also the ECB and other central banks are currently having. The other question is, and we haven't talked about this yet, but if you talk about other longer term shocks to the economy, AI, climate change, two other important factors, where every central bank needs to find out and to figure out if these longer term trends are now inflationary or rather disinflationary. I think with AI, I think the current thinking is that it's rather disinflationary. With climate change, I think the argument, especially in Europe, is that at least tackling the consequences of climate change will be inflationary. And this makes monetary policy extremely complicated. Could then also mean that if central banks don't dare to actually be forward-looking anymore, that they rather really focus on the very short term, and instead of indeed making forward-looking monetary policy, that they rather focus on actual headline inflation, actual wage developments. So that is the tricky thing. And when you look at the ECB, it's always funny that the predecessor of Christine Lagarde, there was Jean-Claude Trichet. he always talked about that the ECB had a compass, and the compass only had one needle, and this needle was always pointing to price stability.
Right.
Well, it's no longer that easy right now, because many factors, many elements are actually pushing this needle, yeah, it's hard for us in the private sector doing economic research to come up with good predictions of what's going to happen. Well, tomorrow, but let's stand in a year from now. The ECB and other central banks are facing even bigger challenges, because they do not only have to make these predictions, they are also have to make policies based on these predictions, something no private sector economist has to do.
But if I remember correctly, Carsten, I think the full employment is also one of the mandates of the ECB's larger mandates that have been set, right?
Yeah,
Uh,
it's different from the US or from the Fed, where the
right.
Fed really has this dual mandate, which is
Yeah.
full employment and price stability. In case of the ECB, it has a primary objective and a secondary objective. The primary objective is price stability, and the secondary objective is to support the economic policies of the European Union. Um, and uh, and one of the policies of the European Union is achieve full employment in Europe.
Yeah. Talking a bit on macros, Carsten. After Russia-Ukraine war, the Middle East crisis will dent the euro economy undoubtedly. What lesson has the ECB learned during the previous crisis that can be implemented today, in your opinion?
Yeah, I would say not to rush to conclusions is clearly one. To be really a bit more in a wait and see stance. Not to rush is an important one. Um, the the other one is that there is clearly also more to the ECB's monetary policy than only its policy interest rate. And and we talked about all these elements. So there are liquidity injections. There are loans that the ECB can give to commercial banks. There is the tool that the ECB, in case any of these kind of crises leads to a sovereign debt crisis, there are tools that the ECB can use and apply to tackle any unwarranted widening of sovereign spreads in Europe. So the other predecessor of Christine Lagarde, Mario Draghi, he always talked about the toolkit, the toolbox that the ECB clearly has at its disposal, and this toolbox has clearly grown throughout these crises. And I think what the ECB should have learned is that it should never hesitate to really use all of these instruments, as controversial as they were at the time they were put in the toolbox, but that right now the ECB should never hesitate to use them if need be.
What kind of asymmetries are you seeing in growth risk across EU member states right now, Carsten?
Yeah, it's interesting. So we entered this year thinking that there would be a bit of a revival of German industry on the back of fiscal stimulus, for defense, for infrastructure. Now with the war in the Middle East and the energy price shock, this story is at least be delayed, hope not derailed, at least not for the time being. But without the war in the Middle East, we would have had a story in which Germany and some other core countries would catch up again, and we would have a new rebalancing of the Eurozone. Because over the last years, it was actually mainly the Southern European countries that did extremely well, and it was the core led by Germany, that was doing not so well. So we saw a bit of a reversal of this situation. Now, with this ongoing energy price shock, potentially also a broader supply chain disruption again. This means that it will again be the countries with the biggest industrial backbone, read Germany, also read Italy, that will be hit the most. And that will then also lead to more asymmetry or more divergence. The other element, but that is slightly too early. Southern Europe has clearly also benefited from tourism over the last couple of years. If now the situation in the Middle East leads to really more flights being grounded this summer, and we do see some anecdotal evidence. We do see first airlines announcing that they are canceling actually quite some flights for the summer. This could be a bit of a counter movement that we will see less tourism in Southern Europe, which would make the divergence milder, but which would also unfortunately not improve the picture for the Eurozone as a whole.
Interesting. Are you concerned about bond yield divergence across the Euro states in the current crisis, Carsten? Especially if the ECB decides to increase rates as a signal to anchor inflation expectations?
No, currently not, in all honesty. I think because we also saw that at least in the former more problematic countries, we saw that there had really been solid or relatively solid public finances, and which are reflected in relatively stable up to narrow spreads. So I think a big risk or a big trigger would be really if all of a sudden we were to see in any country that the political willingness to stick to Europe's fiscal rules would again stop. That is nothing that I currently do see. If another element could be a bit similar to what we saw during the pandemic, that if all of a sudden the fiscal rules stop governments from providing any emergency fiscal stimulus to tackle the adverse effects of higher energy prices. So that is something that then in turn could again lead to a widening of spreads. But in all honesty, I think this is also hypothetical. In practice, I'm not seeing or witnessing any of these trends, which means, well, for the time being, I'm really pretty relaxed when looking at spreads, when looking at the risk of a new sovereign debt crisis. Having said all of this, we know that it very often is not economics, but it's rather political will, political willingness, or the lack of which that could always revive fears of a new sovereign debt crisis in Europe.
How do you see EU's vulnerability to the current crisis as compared to the US and China?
Well, that is also, I think, a story that could fill another full episode of your podcast. So I think again, short-term impact. So we're talking about an energy and a kind of transportation shock. So here, I think who's exposed the most? It is Asia to the Strait of Hormuz. Then it's Europe, and hardly is the US. So this already gives you the ranking. And I think that's the important one. We should look beyond this as horrible as the war is and the blockade of the Strait of Hormuz is, or if we look beyond these things, we know that Europe has lost international competitiveness vis-a-vis the US and China. We know that especially China has become an enormous economic rival in sectors that were previously dominated by Europe, whether it is automotive, but whether it's also renewables. So China has become the better industrial Europe, and this immediately points us to the vulnerability of Europe. So Europe needs to watch out that it doesn't rest or is lost in this near term crisis management, how to tackle an energy price shock right now. But Europe really needs a longer term strategy on how to improve its competitiveness, how it's going to strengthen the internal market in Europe, how it is becoming more self-dependent when it comes to energy, how it will be able to become also more self-dependent when it comes to security and defense. And here, Europe always takes a long while to really wake up. I thought that at the start of the year, also when we had this Greenland conflict, that Europe finally woke up or had woken up. But now it's really, I think it's of the essence that Europe now, so despite this current energy price shock, that Europe doesn't forget to really implement the reforms needed, the investments needed, the institutional reforms needed to strengthen its own economy, because otherwise it will remain always more vulnerable to any external shock than the US and China.
Since we are talking about the European Union, we must talk about Germany. As you mentioned, Carsten, Germany has traditionally been Euro area's growth driver and the core's backbone. But exports have been struggling due to competition from China and other factors, especially the auto industry. How do you see the revival of the German economy going ahead? And what should the policymakers, especially the Bundesbank, in coordination with the ECB, do in this regard?
Yeah, it's more than happy. What I just said about Europe, of course,
Yeah.
clearly applies even more to Germany. So if there is one country in Europe that had been living on a model that was based on strong exports, because there was simply such a strong demand across the world for its products, it's Germany. Germany was also a country that to which the price of energy never mattered. Now it does. Now changes in the world do matter. Now the rise of China as a full rival clearly matters. And you mentioned automotive, because I think that's the most symbolic sector for Germany, I would say for Europe, where we do see that China has clearly caught up, at least when it comes to electric vehicles, when it comes to maybe in the lower price segment vehicles, but sometimes already also in luxury cars. So that is one. But then there is more. So also when you look at the industry or the sector of renewable technologies, when you look at the chemical industry, so China is really has become the better industrial Europe. And if there was one country in Europe that had been so depending on its industry, it's Germany. So how does Germany get out of here? A bit like Europe as a whole. First of all, it needs to have the awareness that this is happening, and that is not fully there yet, unfortunately. So Germany needs clearly more investments, that have been announced, and that is first investments in infrastructure and defense. This year alone, from an off-budget vehicle plus the annual budget, Germany will spend more than 200 billion euro on defense and infrastructure. That is enormous, and it will continue for a couple of years. So that is one thing. Okay, clearly invest. But you also need more structural reforms. And structural reforms goes to make your pension systems, your healthcare systems more sustainable financially, in order to have more room for budgets, for public finances to do useful stuff. Germany also needs to invest in its education, in its educational system, because Germany doesn't have commodities. Germany's commodities are human capital. It's brains. And then Germany also needs to be again more attractive. There should be lower taxes. And the final point, and that's of course also ties the link to the current situation, is Germany needs a long-term energy strategy. Germany no longer has an all-encompassing energy strategy for the next 10, 15 years. And that is something that Germany urgently needs to develop. So how can Germany have affordable energy prices for industry, for households, for an economy, for a global economy that increasingly will live on energy? Because when you look at data center, when you look at AI, when you look at everything, so the appetite for energy will just go up. And if Germany doesn't find a solution here, as a former industrial engine, then Germany will remain way out. I think these are many areas that Germany needs to tackle. How can policymakers help? Well, I think there is only a very small role here for monetary policy. Yeah. You can an ECB can make obviously investing slightly cheaper. Yeah, by keeping interest rates relatively low. That is something they could do. But I rather see here a educational factor for the Bundesbank and also the ECB. So to use their credibility that they do have with the broader public in educating, in explaining that something really needs to change. Yeah, so that that is a tricky one, because Germany, as many other European countries, is also now subject to demographic change. We know that older societies are not really open for change. They rather like status quo. But really educate and explain how the world or how life for the average German will look like if the country does not turn the economic model around. That we might have a country that will have a kind of deteriorating industrial backbone, which also means less well-paid jobs, etc., etc. So if Germany doesn't turn this whole thing around, the risk of a gradual loss of economic wealth in the entire country is pretty high. And here I think the ECB and the Bundesbank have a good role to play to educate. And then it is up to the government, it is up to companies, it is up to everyone to become more flexible, to really start embracing new technologies in order to try to break with certain traditions and to try to bring the German economy back to glory. This is a country that managed to do so several times in the past, but it only really needs to wake up. That it is, I wouldn't say it's 5 to noon. It is probably already a few minutes past noon right now, or past midnight, and Germany really needs to wake up that something has to change. Unfortunately, many Germans have made themselves very cozy, very comfortable in a never ending present, and and that is unfortunately only exists in fairy tales, but not in the global economy.
Right, right. If the Iran situation escalates further, Carsten, will the ECB focus on financial stability or inflation control as a trade-off policy? You can
Good.
talk about the trade-off or the choices available on the table.
Yeah, it's a very good question. I think well, initially, I think they would try to demonstrate their inflation fighter spirits, and they would go for rate hikes. But the ECB, as does the Fed, knows that it in the past it was always tighter monetary policy that in the end led to financial market turmoil,
Right.
financial instability. And I think that this time around, especially given that this is an energy price shock, we're not talking about inflation as a result of an overheating economy. So we're really talking about an exogenous shock. So that this time around, the ECB would eventually focus more on the financial stability risk rather than inflation, because I cannot see that neither the ECB nor the Fed would like to tackle a exogenous inflationary shock at the cost or at the risk of causing another financial market crisis. So therefore, I think when push came to shove, they would choose for financial stability.
Okay. So in the longer term, it would be financial stability and not inflation
Yeah,
control.
yeah.
Right, right. As a global economy tries to reduce dependence on a US-centric model, there is a growing demand for a second pillar, Carsten, to provide stability and alternative liquidity. Do you think the euro has what it takes to emerge as an alternative currency to the USD?
Well, last year we had a speech by Christine Lagarde, the global euro moment speech. I think back then it was quite some wishful thinking, and I think Europe also needs to watch out that it doesn't do wishful thinking. Europe needs to deliver. If currently Europe is not yet a full alternative to the US dollar. There is only one capital market in the world that has the depth and liquidity of the US, and that is the US. No
Right,
other markets. If
right,
everything we discussed here in this podcast, if Europe, if Germany delivers, if the European economy becomes again competitive, and on top of that, we see more European integration. We also see finally a capital markets union in Europe. Then I
mm,
think Europe could be this alternative of liquidity and stability. If Europe indeed would be able to have its own military security, defense, plus a fully integrated economic union, then indeed the euro would emerge as a viable alternative to the dollar. But unfortunately, we're not there yet.
right. So you mentioned about the fragmentation among individual countries, and that includes, of course, Germany, France, and Italy, which limits the total supply of highly rated safe debt, including both private placements and sovereign debt, available to the financial system. Keen to know your thoughts on whether you see a case for the euro bonds, an idea that was once floated by Mario Draghi and other ECB heavyweights.
Yeah, this is a debate, Karen. You know this. I think you put 10 economists in a room and you will get 15 different views and answers. Um, I think I still see the theoretical advantage of a Eurobond.
Mm.
Practically, in all honesty, every investor can construct his or her own European sovereign bond portfolio. So there would be a Eurobond plus, given the money that the German government will spend over the next couple of years. The German government debt will go from 60% of GDP to around 80-85% of GDP. So all of
Right.
this will have to be financed. So there is your kind of safe asset, and that is German bonds. So just from this kind of argument, I think right now there is no real need for a Eurobond. If, and that's the other thing, if Europe was to decide on really increasing or having a European or a Eurozone budget, and a
Right.
Eurozone budget that would then be financed by Eurozone debt, could be a different story. But so this is, I think, the Eurobond discussion has always been a symbol for, are you against or in favor of more European integration? I think it's much more complicated than that.
Right.
It is really, yeah, so they're given this increase in government debt across Europe. There are enough assets that any investor can buy. I see, as long as we don't have a political union, I simply don't think that that we will get a Eurobond in the sense of really full burden sharing. Because
Right.
I cannot see, yeah, like that, if Germany now really sees its own government debt increasing so quickly, I cannot see that on top of that the German government would agree to even more European debt. So this is why I think we will continue discussing the pros and cons of a Eurobond again for the next 5 to 10 years without reaching conclusions. Having said all of that, final word, Karen, is to some extent we do have a Eurobond, but that is
Right.
more a European project bond. And so which means for special purposes, limited over time, the Next Generation EU, so the pandemic fund, is a vehicle that was nothing else than a project Eurobond. The
Mhm.
financial support for Ukraine is also nothing else than a Eurobond, but only really kind of really limited in terms of time and in terms of target or purpose.
Right. So for all intents and purposes, Carsten, unless and until there is no fiscal union in the Eurozone, the concept of the Eurobond as a physical asset won't be possible.
At least I would say it will not be politically feasible. Let's put it there.
Right. Right. Wonderful. Well, that's all I have for today, Carsten. This is an incredible assessment of the euro economy, especially since this is coming from you. I'm sure your insights and expertise of the euro economy and the ECB will add a great deal of value to our audiences across the world. Thanks once again for the time, Carsten.
Thanks for having me. It was a big pleasure.
Thank you.